So, why do some argue that 2025 could be worse than 1929 and 2008 together? Because we seem to have a combination of three elements: stock market bubbles like 1929, debt bubbles in housing and credit like 2008, and a government debt bubble that was not present on this scale in either period. All three stress points move at the same time. In 1929, mainly stocks crashed and only a small part of the population was directly invested. In 2008, housing crashed, but the government still had room to borrow and the Fed still had space to cut and print without immediate inflation. In 2025, the argument is that everything is under pressure at once and the old tools are weaker. The warning signs people point to, it from the inverted yield curve to heavy insider selling to big investors hoarding cash, are all part of this picture. They suggest that several key indicators are flashing red at the same time. The timeline some people draw is based on past patterns of when recessions follow yield curve moves and when large amounts of debt need refinancing. They argue that the trigger could come at almost any moment, and that once a real cascade starts, it will be very hard to stop. From that perspective, this is not just a wild guess about the future, it is more like pattern recognition, seeing that many of the same signals that appeared before past crises are now visible together, but on a bigger scale. The conclusion for them is clear: a crash is coming. The open question is not if, but how prepared each person will be when and if it happens. The housing market can then freeze. Buyers disappear and sellers do not want to accept much lower prices. Listings sit for months without offers. People who must sell for personal reasons start cutting prices. Those sales set new comps that pull down valuations in whole neighborhoods. In some areas, prices could fall 20 to 30% in 6 months, and much more in the most overvalued markets over a year. Recent buyers may find they owe more on their mortgage than their home is worth. Commercial property owners who cannot refinance give properties back to the bank. The bank takes a building that is worth maybe half the loan amount and must recognize a big loss. Enough of these losses will eat up bank capital. When banks drop below required capital levels, regulators step in and close them. In the 2008 episode, 465 banks failed. Over 5 years, a future crisis could potentially hit similar or bigger numbers over a shorter time if conditions get bad enough. Bank failures create fear even around healthy banks. People see news of one failure and rush to move their money from any bank they worry about. This is the classic bank run problem. No normal bank keeps enough cash to pay every depositor at once to raise cash. They must sell assets. If they sell assets quickly at low prices, they take losses that can make them insolvent too. The FDIC steps in, but with limited funds, it cannot cover a wave of giant failures without government money and money printing. As all of this happens, unemployment can move up quickly. Companies with falling revenues cut costs. Tech firms that grew large during the boom cut 10 to 20% of staff. Finance firms with market exposure do the same. Retail and service businesses close locations as customers pull back. Within a few months, the unemployment rate can jump several points over a year. Very high unemployment is possible in a severe scenario. The Federal Reserve then faces a hard choice. It can cut rates and launch new QE to try to stabilize markets, but that risks bringing back high inflation that people still remember from 2021 to 2023. Or it can hold back to protect the currency and let the downturn deepen, with unemployment staying high for years. There is no easy middle road if trust in their tools is already weak. For ordinary Americans with retirement accounts in 401ks or IRAs, a 60 to 70% fall in portfolio value would be more than just a number on a screen. Someone who spent 30 years saving and built $600,000 could see it drop to around $200,000 or less. That changes their life plan. They may not be able to retire. They may have to work 10 to 15 more years if they can find work at all. For people already retired and living off their portfolios, the problem is even more painful. They must sell into a down market just to pay bills, locking in losses that may never be recovered if the rebound is weak or slow. Housing losses keep people stuck in homes they cannot sell without taking big hits. Young people graduating in 2026 and 2027 could face a job market with very few openings. When they finally find jobs, pay may be lower and career growth slower. Research on earlier recessions shows that people who graduate into a deep downturn often earn less over their whole careers compared to those who finish school in better times. Small businesses carry a lot of the damage. As consumers cut spending and credit dries up, local restaurants, shops, and family businesses struggle. Many close. Big corporations with easier access to capital survive and may even grow their market share. After the crisis, the economy can become even more dominated by large firms. That usually means less competition and less innovation. Social safety nets like unemployment insurance, food support, and public health services get hit from both sides. More people need help at exactly the time when tax revenues fall. Governments then face painful decisions about what to cut. This can turn an economic crisis into a social and humanitarian one, especially for older people, disabled citizens, and others who rely on government programs. History shows that big economic shocks often lead to political shocks. In the 1930s, economic pain helped fuel extremist movements in Europe. Hyperinflation in Weimar Germany played a role in the rise of Hitler. The U.S. is not immune to such risks. When people lose their jobs, savings, and homes, they often look for someone to blame and may support more radical political answers. A big crash in 2025 or 2026 could reshape U.S. politics in ways that are hard to predict. Unemployment has also started to turn. From a low around 3.4% in early 2023, it has risen to about 4.1% by October 2025. That number still sounds low by historical standards, but the direction matters. The Somme rule, created by economist Claudia Somme, says that when the 3-month average unemployment rate rises 0.5 percentage points above the low of the previous year, the economy is in recession. This rule has matched every recession since 1970. As of late 2025, we are close to that trigger. Once unemployment starts rising, it often speeds up, as one round of layoffs leads to others. Auto loan delinquencies have climbed to levels not seen since the 2008 crisis. Around 7.5% of auto loans are 90 days or more late, the highest since 2009. Monthly payments on new cars are very high, often above $740, and loan terms have stretched to 84 months. In practice, this is another form of subprime lending. People who cannot really afford these cars are being given long, expensive loans. When they default, it harms not only the lender but also their ability to get to work, which can then cost them their job. Student loan problems are also growing. After payments restarted in October 2023 following a 3-year pause, delinquencies have risen. Total student loan debt is about $1.77 trillion dollars spread over roughly 43 million borrowers. Many people feel they will never pay it off and choose to default. That pulls tens of billions of dollars each year away from other spending like housing, starting families, or buying goods. A generation that should be pushing the economy forward is stuck servicing debts with little return. Geopolitical risk adds another layer. In 2025, there are ongoing wars in Ukraine and the Middle East, constant worries about a possible conflict over Taiwan, and a world economy that is splitting into rival blocs. Any of these could escalate and hit energy supplies, food supplies, or key industrial chains. A sharp spike in oil prices similar to the 1970s could create stagflation, a mix of inflation and recession that is especially hard to manage. Markets dislike uncertainty, and geopolitical uncertainty is very high. Commercial real estate stress is already visible at big institutions. For example, some large asset managers have defaulted on office tower loans in major cities. Other giants have limited investor withdrawals from some property funds, which is often a bad sign. When sophisticated players start walking away from properties, it suggests the numbers no longer work. As more mortgages come due in 2025 and 2026, more defaults and bank losses are likely. If a crash begins, it may not start with one clear dramatic event. It could be something that looks manageable at first, a big tech company missing its earnings target, another regional bank failure, a sudden geopolitical shock, or a political fight over the debt ceiling. The exact trigger may not matter because the system is already fragile. What matters is how one shock leads to another, and then another in a chain that is hard to stop. If a company like Nvidia or another of the Magnificent Seven disappoints, algorithms may start selling immediately. The stock could drop sharply in a single day. Other tech giants might fall in sympathy. Within days, the group could be down 20 to 30%, pulling the whole market down several percent. That kind of drop triggers margin calls, forced selling, then pushes prices even lower, creating a feedback loop similar to 1929. Big institutional investors who manage pensions and endowments also have risk rules that tell them to cut exposure when losses reach certain levels. These are automatic, not emotional. When those systems fire, they add more selling pressure. In a month, some scenarios suggest stocks could be down 30 to 40% as retail panic. Margin calls and institutional rules all feed each other. From there, the shock can move into bonds. Investors try to escape into what they think is safety, but the government is also trying to sell more bonds to cover deficits and refinance older debt. If supply and demand meet at the wrong time, interest rates jump even higher. That increases the government's interest costs, which forces more borrowing, which means issuing more bonds, which pushes rates even higher again. This doom loop has broken countries before, often ending in default or high inflation. In 2025, China faces its own real estate problems, heavy local government debt, and a shrinking population. Europe is dealing with an energy squeeze, aging societies, and political divisions. There is no clear large economy ready to pull the world out of trouble. Geopolitical tensions are higher, which makes coordination more difficult. When the next crisis hits, each country will likely think first about its own survival. One of the strongest signals of coming recessions in the last 70 years has been the inverted yield curve, when short-term interest rates go above long-term rates. This pattern has predicted every recession since 1950 without a false signal. The yield curve inverted in July 2022 and stayed that way for 27 months before normalizing in September 2024. Historically, recessions usually begin 3 to 12 months after the curve goes back to normal, not while it is inverted. That means the risk window is roughly October 2024 to September 2025. According to this view, we are inside that window. Consumer debt is also at worrying levels. Credit card debt is over $1.14 trillion, the highest ever in nominal terms. The average credit card balance is around $6,800 per household, with interest rates often between 21% and 28%. Serious delinquencies, where people are 90 days or more behind on payments, are back to levels last seen after the 2008 crisis. This is important because consumer spending makes up about 68% of the U.S. economy. When people are maxed out and cannot borrow more, they have to cut spending, which slows the whole economy. The commercial real estate problem is still developing, but could speed up through 2025 and 2026. Over $2 trillion in commercial mortgages will come due and need refinancing. Many of these loans were made when rates were around 3%. Now rates are more like 7 to 9%. Buildings that only just worked at 3% often fail at 8%. Values have already dropped 40 to 60% in some markets because buyers know the properties cannot support the same debt at current rates. If owners cannot refinance, they will default and hand the keys to the lender. Regional banks that hold a lot of these loans will take heavy losses, which can wipe out their capital. We already saw some warnings in 2023. Silicon Valley Bank collapsed in March 2023 in the second biggest bank failure in U.S. history. Signature Bank failed the same week. First Republic failed in May 2023 and was sold to J.P. Morgan with help from the FDIC. New York Community Bank came close to trouble in early 2024. And this was all before a full recession. When a real downturn starts and loan defaults rise, many more regional banks could fail. If that happens, the FDIC's $125 billion fund will be used up quickly. The government will then have to print money to protect deposits, which can hurt the dollar's value. At the same time, the stock market's big dependence on the Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, has created new fragility. These 7 stocks make up around 30% of the S&P 500. Nvidia alone, with its very high price-to-earnings ratio, is about 7% of the whole index. If Nvidia's earnings disappoint or AI hype cools down, the stock could drop sharply and pull the whole market lower. The concentration of risk is unlike earlier periods. Insider selling is another warning sign. When company executives with inside knowledge sell large amounts of their own shares, it often means they think current prices are too high. People have noted that Jeff Bezos has sold big amounts of Amazon stock through 2024 and 2025. Mark Zuckerberg has sold large blocks of Meta stock. Nvidia executives have also sold while prices were high. Similar patterns appeared before past crashes. At the same time, Warren Buffett, often called the most successful investor in history, is holding unusually high levels of cash at Berkshire Hathaway, above $300 billion. He has reduced some big positions, including part of his Apple holdings, and bought more treasury bills. He has said that valuations are too high and that he cannot find enough attractive investments. His own measure, the Buffett indicator, which compares total stock market value to GDP, is around 185%. He has warned in the past that numbers above 120% signal danger. At 185%, the warning is clear from his point of view. In 1929, the Federal Reserve still had credibility and room to act. It was created only in 1913, so it did not yet have a long record of mistakes. It could have cut interest rates faster but did not fully understand the situation until too late. By 2025, the Fed has spent about 15 years showing its limits. After 2008, it used big rounds of quantitative easing and held rates very low for a long time, which many people believe helped inflate the current bubbles. Then in 2022 and 2023, it raised rates aggressively to fight inflation, which created new risks for the economy. Many people no longer trust the Fed to manage the cycle well. Even more important, the tools it used in 2008 are not as effective now because they were overused. The 2008 crisis is still a key example for what might come in 2025 and 2026. That crisis started with subprime mortgages, loans to people who could not really afford them, which were then bundled into complex securities and sold all over the world. When home prices stopped rising, borrowers could not refinance and started to default. The default spread through the system, showing that banks were highly leveraged and holding assets that were suddenly worth far less than they thought. In 2025, subprime style risk exists in many places, even if we do not always call it that. There are very long auto loans at high rates to weak borrowers. Credit card debt is at record highs with average rates above 21%. Student loans total about $1.77 trillion, and a big part of that will likely never be fully repaid. Corporate debt has jumped from about $2 trillion in 2008 to more than $10 trillion as companies borrowed cheaply to buy back their own stock. Back in 2008, most of the leverage was concentrated in housing and mortgage-backed securities. Banks like Lehman Brothers were leveraged around 30 to 1, which meant that a small drop in asset values could wipe them out. When Lehman failed in September 2008, it triggered the worst financial panic since the Great Depression. In 2025, leverage is not in just one corner. It is almost everywhere. The derivatives market has notional value above $600 trillion, about 10 times global GDP. A lot of these are interest rate swaps and credit default swaps that can blow up if rates move strongly or big companies start to default. The connections are so tight that one big failure can quickly lead to others. In 2008, the Fed still had strong tools. Interest rates were around 5.25% when the crisis began, so they could cut all the way to zero to support borrowing and spending. The Fed could also do massive quantitative easing, buying trillions in treasuries and mortgage securities to push money into the system. The Fed's balance sheet grew from about $800 billion before the crisis to around $4 trillion by 2014. That emergency money printing helped avoid a full collapse, but also helped create the bubbles we face now. In 2025, rates are already relatively low, so there is less room to cut. If the Fed cuts too much, it risks waking up inflation again, just after a tough fight to control it. If it does not cut enough, it risks letting the economy fall into a deep recession or even depression. Quantitative easing is also less effective now. The Fed's balance sheet is already above $7 trillion after several rounds of QE following 2008. And again during COVID, people now know that printing too much money can cause serious inflation. The surge in prices between 2021 and 2023 proved that. So the Fed is caught print and risk destroying the dollar's buying power, or do nothing and risk a deep collapse. The government's aid bailout capacity is also weaker. In 2008, federal debt was about 67% of GDP, which was still manageable. The government could launch programs like TARP, a $700 billion plan to buy bad assets from banks, plus other programs that brought total support close to $2 trillion. It was unpopular but possible because there was still borrowing room. In 2025, federal debt is about 125% of GDP and deficits are already in the trillions. There is far less space to borrow another couple of trillion to save failing banks and companies. If the government tries, bond markets may push interest rates higher, making the debt problem even worse. The bailout tool that worked in 2008 is much harder to use now. Globally, the situation is also less friendly. In 2008, China was growing fast and helped the world recover by boosting its own demand and buying raw materials. Europe was hurt by the crisis, but was not stuck in the same level of debt as the US governments cooperated through the G20 to coordinate stimulus. The third bubble, the one that makes 2025 so unusual, is in the bond market. Government bonds are supposed to be the safe asset you move into when stocks crash. In 1929, bonds were stable while stocks fell 89%. In 2008, U.S. Treasuries rallied as investors escaped from stocks into safety. In 2025, bonds are falling together with stocks because the U.S. government has issued so much debt that the bond market struggles to absorb it. Total federal debt is over $36 trillion, about 125% of GDP. This is similar to the debt to GDP level at the end of World War II. But after World War II, America was the only major economy not destroyed by war. Today, the U.S. is competing with other countries that have lower debt and stronger fundamentals. The yearly interest payment on this debt is now above $1.2 trillion, which makes it the single biggest item in the federal budget. It is bigger than defense spending and bigger than Social Security. When interest costs are this high, the government has three main choices. It can cut spending hard and risk a recession. It can raise taxes sharply and risk a recession. Or it can print money to cover the interest and risk more inflation. All three paths are painful. There is no clean way out when interest payments alone are as big as the whole GDP of a country like Mexico. This is what people mean by the everything bubble. Stocks are overvalued at levels that appeared only twice before, and those two times were followed by crashes. Real estate is more overvalued than in 2008, and bonds, which used to be a safe haven, are under pressure from huge government debt. The similarities between 2025 and 1929 are so strong that it feels like watching history repeat scene by scene. In 1929, stock valuations reached levels that had never been seen before. The price-to-earnings ratio of the Dow Jones Industrial Average hit about 33, far above past norms. In 2025, the S&P 500 trades around 28 times earnings, which is in the same extreme zone. Back then, the public believed that new technologies like electricity, radio, and the automobile had created a completely new economy where old rules did not apply anymore. People kept saying, this time is different. In 2025, AI is the new magic technology that many believe makes the old rules irrelevant. In 1929, margin debt, borrowed money used to buy stocks, reached record highs as people from all kinds of jobs used leverage to join the boom. There were stories of ordinary workers getting rich overnight through speculation. In 2025, margin debt as a share of GDP is also at very high levels. But now, leverage is not only in margin accounts. Options trading by retail investors has exploded. Some people even use credit cards to buy stocks. Companies borrow money to buy back their own shares at high prices. Leverage is all over the system, hidden in derivatives, options, and complex debt that most people never see. Wealth inequality in 1929 was already extreme. The top 1% earned about 25% of total income. The economy depended heavily on a small group of wealthy people continuing to spend and invest. When they pulled back, the system broke. In 2025, the gap is even wider. The top 1% now controls around 32% of total wealth. The economy depends heavily on the top 10%, who account for about 70% of consumer spending. If wealthy households cut spending, because their portfolios crash, demand disappears and the economy falls. Here's where 2025 is actually worse than 1929. In 1929, most Americans were not in the stock market. Only around 10% of households owned stocks. So when the market crashed, 90% of people were not directly hit in their savings. They suffered later through job losses and falling prices, but the crash did not immediately wipe out their retirement accounts because they did not have them. In 2025, about 58% of U.S. households own stocks either directly or through retirement plans like 401ks and IRAs. When markets fall, more than half the country sees their retirement savings fall with them. There is no real buffer. The damage is immediate. The banking system also looks different. In 1929, banking was spread across thousands of small banks with no federal deposit insurance. When the crash came, people panicked and pulled out their deposits. Many banks failed and customers lost their savings. Today, there is FDIC insurance that promises to protect deposits up to $250,000. But the FDIC fund itself holds only about $125 billion while insuring around $10 trillion in deposits. If several big banks fail at the same time, that fund is far too small. To make all depositors whole, the government would have to print large amounts of new money, which would hurt the value of the currency through inflation. So people either lose money through bank failure or lose purchasing power through inflation. It becomes a choice between two kinds of pain. In 1929, the stock market crashed and America entered the Great Depression. Stock prices fell 89% over 3 years. Unemployment reached 25%. Many banks failed and people lost their savings. It took 25 years for the market to come back to the same level as 1929. In 2008, the housing market crashed, and that started the Great Recession. Stocks fell 57% in 18 months. Unemployment went up to 10%. Banks needed bailouts. Retirement accounts were hit badly. This time, markets recovered in about 5 years. But 2025 is different. Now, stocks, bonds, and real estate are all falling at the same time in what many financial historians call the everything bubble. When everything falls together, there is nowhere safe to hide. What if I told you that this situation is not really new? It is more like being in 1928 again, right before the Great Depression. Only this time, it is worse because the tools that helped after 1929 and 2008 are no longer available in the same way. The Federal Reserve cannot simply cut interest rates to zero because rates are already low. They cannot just print unlimited money because they already did that, and it created the worst inflation in 40 years. The government cannot easily bail everyone out because it already has $36 trillion in debt. Let me show you why almost every major financial signal is flashing red. Why some people think the crash window is between November 2025 and June 2026. And why the next collapse could destroy more wealth than any event in modern history. This is not about feelings, it is about math. To understand why 2025 is different from earlier crashes, we need to see that this is not just one bubble. We are living in three bubbles at the same time. And this combination has never happened before in financial history. Let's start with the stock market. The S&P 500 is trading at a price-to-earnings ratio of 28, almost double the historical average of 15 to 17. This kind of overvaluation only appeared twice before. Once in 1929, right before the Great Depression, and once in 2000, right before the dot-com crash that wiped out 78% of the Nasdaq's value. Both times the market crashed within months after reaching those extremes. But in 2025, the concentration risk is even worse than in 1929 or 2007 stocks. Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla make up around 30% of the whole S&P 500 by market value. If these 7 companies crash, they can pull the whole index down with them. This kind of concentration has not been seen since 1929, when a small group of industrial stocks held up the market before everything collapsed. In 2000, the bubble was also in technology stocks, but they were a smaller part of the total market. Today, the concentration is more extreme, more dangerous, and more fragile. Nvidia is a good example of how crazy valuations have become. The company trades at a price-to-earnings ratio above 65, so investors pay $65 for every $1 of profit. Nvidia's market value is more than $3 trillion, which is higher than the value of the entire German stock market, even though Germany is the 4th largest economy in the world. This is not careful valuation. This is speculation fed by AI hype that looks very similar to the internet hype in 1999. Back then, everyone said the internet would change everything. In the long term, they were right, but they were wildly wrong about what that meant for short-term stock prices. The same pattern is happening now with AI. The second bubble is in real estate. And by some measures, it looks even more overvalued than the 2008 housing bubble that nearly broke the global financial system. In November 2025, home prices are about 50% above their long-term trend compared to income and rent. At the top of the 2008 bubble, they were about 35% above trend. That means the current housing bubble is roughly 43% bigger than the bubble that caused the Great Recession. The crisis that needed trillions in bailouts and almost destroyed capitalism was based on a 35% overvaluation. Now we are at around 50%. And many people do not even feel like we are in a bubble because high prices have lasted so long that it feels normal. And that is only residential real estate. Commercial real estate is already in trouble and moving into a slow-motion crisis that could speed up through 2025 and 2026. Office buildings across the U.S. cite about 45% empty because remote work has become permanent. In San Francisco alone, the vacancy rate in office buildings is around 35%. These properties were financed when interest rates were about 3%. Now those loans are ending and need to be refinanced at 7 to 9%. The buildings simply are not worth enough to support the new debt payments at 3 times the old interest rate. That means defaults, losses for banks, and a chain of failures that could look a lot like the 2008 subprime crisis, but this time in commercial property instead of housing.